and really happy to be part of this webinar. It's always nice to exchange ideas as we get into a new year and hear what other people's outlooks are. My name is Shiv Arora. I lead the team here at Superior Homes. We are master planned real estate developers, with our flagship development being Green Park Estate in Athi River. We have our Lake Elementaita Mountain Lodge. We have Pazuri at Vipingo, Sundowner Hotel, and we're looking at new developments within the counties as well. I've previously served in a number of roles within the investment management industry with Britam Asset Managers, Site and Investments, Citibank as well. So really glad to be here and speak about where we saw the alternative investment space in the year 2020 and really where do we see it going forward in 2021. If you generally look, Rose, do I just get started?
Yes.
Super. If you look at Africa's macroeconomic outlook at the start of 2020, it was broadly positive. There was growth estimates with regards of around 4.1%. There was general fundamentals, which seemed to be improving, which was rapid urbanization. There was movement in terms of income levels in the right direction, so increase in income levels. We saw that there was a growing population, an increasing middle class, and that generally bodes well for any investment in alternative investments, be it private equity or real estate. But we have to remember that we, especially in the East African context, we've come on the back of a pretty challenging last couple of years. When we look at all the way from 2018, 2019, and coming into 2020, it was a difficult time. There was reduced credit to the private sector. We saw capping of interest rates, which obviously affected lending once again. We had periods of obviously currency instability within economies around the East African region. So it wasn't necessarily what I would call the most conducive environment for investments anyway. But when you look at alternative investments, private equity, real estate, investors generally have a pretty long-term view. So they're taking 5 to 10 year views into an economy. So I mean, obviously coming into 2020, it was broadly positive. We were looking at growth of between 3.5% to 4%. And obviously being supported by demographics. So it was supposed to be the year where we finally saw a shift away from the challenging economic environment we had always had. But as was the case and has been the case globally, COVID just altered the investment landscape completely. I think we, as especially in Kenya and East Africa, we're sort of doing better than a lot of the rest of the world is doing. Globally, economies are really hard hit. If you're looking at the leading economies of the world, the United States, United Kingdom, the Far East, Europe, they've had a greater impact as well. If you look at the UK, when you combine it with Brexit, and I'm sure Nahashan will talk about it more because he's the expert in these matters. When you combine Brexit and COVID, it's obviously been a very difficult situation. But coming back to East Africa, I mean, our socioeconomic landscape changed dramatically when COVID came into place, and really there was no other headline in the year 2020 other than COVID. Looking at it from a real estate and private equity perspective, let's talk about real estate first. Real estate was dramatically hit. Anyone else was there to witness it firsthand. When you look at capital that flows within a sector, especially real estate, it relies a lot on collection, it relies a lot on sales, and that's ultimately the bloodline of a business. Given the uncertainty in the market, there was obviously a decline in sales, there was a decline in number of transactions, there was a decline in approvals across the sector, and that put the market and a lot of real estate players obviously into a slide. But it also transformed the way that we live. If you look at it from a residential perspective, COVID meant that your home is now your workplace, your home is now your gym, your home is now your eatery, your home is now your classroom, and your home is your full-scale office and boardroom. Zoom has transformed how we work. So yes, there was challenging times, but it also brought in place a different perspective towards the real estate sector. What do people look at. You know, there was a change in preferences, undoubtedly in the residential market, obviously in the commercial office sector. Retail struggled as well because no one can leave their house and go to malls and spend money. And even if you can, you're really just looking at essential services and really nothing else. So, you know, the key is obviously to look at how do these changes affect you as a sector. And we saw it. We saw residential yields come down by more than 1 percentage point. You look at prime residential properties and prices were down around 2.9%. So there was a huge impact in terms of total returns to the sector. So difficult time. And to put it into context, obviously a lack of credit, lack of footfall to sites. When people don't come and visit sites, they don't buy. At the same time, there was very, very little transactions being completed. Lots of developers didn't start projects, and the effect of leverage was felt across the sector. If you look at the private equity sector, obviously hit as well. Now, why do people, and these are global institutional investors, look to invest in private equity in Africa? You're obviously looking for the highest risk-adjusted returns. You're looking at anywhere north of 20%. And you're banking it on fundamentals. You're banking it on economies growing, urbanization. You're looking at a growing population. So when you combine all of those factors vis-a-vis what's happening in the global markets, you know, Africa's economic situation was already precarious come 2018 and 2019. We weren't, as I mentioned before, there wasn't the most solid foundation for people to build on anyway. So 2020 came in and we saw a drastic decline. We saw a 68% decline in terms of total deals that are being completed across the private equity sector. If you're looking at total fundraising, it was down from about $3.8 billion for the entire continent down to about a run rate of around $2 billion. You look at exits, you know, down from about 50 exits to around 20 exits across the continent. So what was the reason for that? Number one, private equity investors couldn't travel. The second was, it was very, very difficult to exit businesses in that sort of an environment. Really, who's going to be buying in the middle of a pandemic? Unless it's a fast-moving commodity, unless it's financial services, unless it's technology. But really, in other business sectors, there was obviously a huge struggle. Capital becomes very, very difficult to find. If Africa stops becoming attractive during a year, it means that people will not raise a lot of capital towards that sector anyway. So it obviously becomes difficult to raise money when your economic prospects are not looking good for the year. It's not to say that fundamentally economies have changed and all of a sudden sectors are no longer attractive, but during that year you will start to see a lot of reduced activity, and we did see that. Generally, so 2020 was a challenging year for alternative investments. You know, prices going down, difficult for the private equity sector, difficult to do transactions, difficult to do due diligence, difficult to close, and then difficult to exit. And also a lot of the businesses, which a lot of people thought were very secure, had very sound business models, were sort of exposed during a very difficult year. So, I mean, in summary, 2020 was a challenging year, but it set the precedent for a lot of reevaluation of how we approach the alternative investment industry.
I have a question on that. How have the industry players from that?
Sorry, how have the industry players
evolved? How has it changed their operations?
Well, I'll talk to you about it from the real estate perspective, and then also from the private equity perspective. How have we evolved given COVID? There's definitely a lot more, we're a lot more risk averse in terms of what we undertake. If you look at it from a Superior Homes perspective, obviously we had a lot of inventory on our books. So the first thing we did was make sure that we push out inventory back into the market before actually committing more capital into the ground. And you generally saw that for real estate players across. There was a lot of repositioning in terms of their assets. You're looking at developers who had, you know, a lot of projects ongoing. There was a lot of phasing. What can I stop, and where's the most efficient use of my resources? So from the real estate side, number one, we generally saw phasing of projects. we also saw a slowdown in capital actually being put into the ground, because we'd rather sell inventory that's completed rather than actually go and build new inventory in a very, very challenging market. We also then, really looked at what can we do to get deals in the market. So there's been heavy discounting really across the entire sector. People have come up with a lot of offers. People are extending payment plans, which they otherwise wouldn't extend. You're being a little bit more flexible in terms of your collections. You're trying to partner and renegotiate a lot of your loan obligations with financial institutions such as banks. So that's how people evolve. There was also a shift from developers building very, very cramped office and residential spaces to building places with a lot more space. And we actually saw that as a trend, where people preferred to build homes where there's actually garden space, where they can sell amenities, where they can sell a work from home experience. So there has been a positive shift in that as well. It's also helped, streamline the sector, because we saw a lot of developments in a very unplanned and unstructured way. And having brought COVID and everyone's back to reality, it's helped shape the sector into what I now believe is a much more robust sector. From the private equity perspective, looking now at businesses that are a lot more solid, there's still a lot of investment, I would say, in the early stage investments, but that's largely in the technology sector. But when it comes to fast moving consumer goods, consumer discretionary goods, when it comes to financial services, when it comes to your general retail sectors, there's a lot more focus on businesses that are fundamentally sound rather than turnaround strategies itself. Because in private equity, you can either sell at a higher multiple, or you can grow EBITDA. But that opportunity to sell at higher multiples is not there. So people are now starting to reevaluate, how do we grow earnings in businesses that we invest in.
I think for real estate currently, a buyer's market mostly. And
yeah, definitely.
I don't know how long it will take before real estate recovers. What would you project? Maybe, perhaps?
Yeah. Rose, look, it's definitely a very, very challenging time for the sector. I can't sit here and say that all is rosy. Like I mentioned before, people are seeing a lot of discounting across the sector because people are having to push inventory that they have. Ultimately, once you've restructured your financial obligations, you have no option but to sell. So people are doing deals which they otherwise wouldn't do in this market. So it is a buyer's market. It's not only a buyer's market on price. It's also a buyer's market in terms of payment plans. It's a buyer's market in terms of, can I get a fitted kitchen? Can I get a fully furnished home? So there has been changes in the sector which have made it very, very favorable to buyers. But you'll also remember, Rose, it's not only a buyer's market completely, because a lot of the buyers who would have otherwise sought mortgage financing, who would have used their savings towards paying for a deposit or a down payment in a home, who would have used their business income towards making monthly installments towards a house on an off-plan basis. Those buyers have also been affected. People have been made redundant, people have lost their jobs, businesses are struggling, and banks are no longer providing the funding that they used to provide. So while it is a buyer's market, it's also very, very important that as a developer, you get the right buyer, someone who's able to actually meet their obligations. And it's put a lot more stress on buyers to be able to demonstrate that, yes, even during these difficult times, we're able to meet our financial obligations. Will this, how quickly will this trend reverse? It's not going to be an overnight sensation. I don't think when we all said Happy New Year's to one another on 31st December, our problems went away. But the market will start to recover. We will start to see a lot of credit flow back into the market. Remember that it can only go up from here as a sector as well. In terms of pricing, I mean, when you're looking at a 7 to 8% correction in terms of pricing in some sectors, a 3% on the overall market, it's obviously going to correct, and it will correct upwards because fundamentals remain strong. Growing middle class, strong economy, Kenya's positioning as a regional hub. So do I expect 2021 to be a very, very great year? No. I think it's a place where people have taken a lot of stock, and they're now going to come back with a sort of aggression that was missing in 2020. But this market will take 6 to 9 months before we can finally say that, yeah, things are back to normal 1.0, because we're in normal 2.0 at the moment.
All right. As we continue, we have some few people who've joined us. This is Shiv Aurora from Superior Homes. Please keep the questions coming through the chat. I hope now you can hear me.
Yes.
I'm audible enough. Yes.
Much better now.
Much better now.
Yes.
Yeah.
All right.
Yeah.
So keep the questions coming. We shall tackle them at the end of the session. Shiv was talking about the private that is the alternative investments, private equity, and real estate at the moment. So we'll have a few words again at the end of the session. But before then, we talked to Nahashon on the global markets, on how they have been performing. I think he's been the man who's been in the newspapers for most of the last year, end of last year. Yeah. Because his product is shining. Nahashon.
Yes. Hi.
Hi.
Okay, thank you very much. So my name is Nahashon Mongai, as you just heard. I'm the Executive Director in charge of global markets here at Standard Investment Bank. And it's under the Global Markets Department that we run the Mansa X Fund. So Mansa X is a multi-asset strategy fund with a focus on global financial instruments. And I suppose that's what Rose was referring to when she said that, it's been a very exciting year for us. So just a quick background about myself. Before I joined the SIB, I was in banking. I was in Bank of Africa, KCB before that, Equity and INM before that as well. So my background is actually trading financial instruments, bias on derivatives. And these are the kind of instruments that we also trade here at Mansa X. So Shiv and Caleb have done a good job of explaining just how interesting 2020 was. For portfolio managers and fund managers across the world, I suppose we all agree that that was one hell of a year. And it's very interesting when you see how 2020 started, everyone was very optimistic. I think it's 1 year where you have the highest levels of optimism across I suppose even for local fund managers as well as global fund managers. Everyone was very excited about how the year was going to start. Just speaking from fund managers who would have been trading global financial assets, we had just come from a year, 2019, the S&P 500, for example, was up over 26%. We were very excited to see how 2020 was going to play out. And it actually started pretty well. And everyone was everyone was bullish across most assets. And then mid-February, the plague hit us. And that was the biggest tail risk event of 2020. I have never seen so many margin calls and liquidation of financial assets as we saw between mid-February and March 2020. Just to give an example, the S&P 500, which I just mentioned earlier, wiped out the entire gain for 2019 in 1 week. And at the time, that was obviously very difficult for any fund manager to wrap their head around this. We as Mansa X, we obviously benefit if we go short assets, but then again, it has to be a little bit more predictable than that. So it was obviously very confusing and tough for most fund managers to trade at around that time. So that was very interesting in 2020, as well as what we saw around April when oil prices dipped to below zero. And this has never been seen before. When oil contracts could not be delivered on time, and market participants actually started paying others to take the contracts off of them, effectively creating a negative price. This has never been seen before in the commodity trading space. So 2020 was very exciting, therefore, in that way. And we did not even anticipate now what happened after that, because after the chaos of February, March, then we have never seen the type of recovery that again was seen in 2020. And I'm talking financial markets here. And it's very important to understand that, for example, Shiv just mentioned the effects that the COVID had on the United States economy. And that's not just the US, you have the same thing happen to Britain and European economies. But we have continued to see continued interference. We like to call it interference by central banks. So they've created a very big disconnect between the underlying economic fundamentals and actually what's happening in financial markets. So the Federal Reserve, in their efforts to show up the US economy, literally printed, because I mean, you can call it what you want, but it's really just printing money. So they expanded their balance sheet by over $3 trillion. $3 trillion. This has never been seen before. This is unprecedented. I mean, we've had stimulus packages before, even if you look at what happened in 2008, 2009. But the kind of stimulus that happened last year is completely unprecedented. And this was also mostly be around the fact that, you know, Donald Trump needed the stock market to continue rising, and it worked. So after the dip I just mentioned on most US stocks, we saw a massive recovery, a very sharp V-shaped recovery, and we actually closed 2020 at all-time highs in the stock market. So we at MansaX, you know, if somebody asks us, was it there for one of the reasons you made money? Obviously, yes, because a lot of assets recovered. We had one-way movements across all the asset classes. The dollar took a hit from a large part of the second half of 2020, because obviously US Treasury yields, you know, continued to dip and have continued to dip up to now, and that is what therefore made 2020 very exciting. And just going back to the Federal Reserve and how the stimulus package is working, because this plays out into how we then predict 2021 to play out. I firmly believe that we are definitely in the biggest bubble that has ever been. If you're living through financial markets right now, this is probably something that would be very exciting to talk about a few decades from now. And I therefore think that in 2021, the hardest thing for most portfolio managers to do, especially those such as ourselves here at MansaX, who are trading in markets like the US and in Britain and the European stock markets, one of the things that we have to be really careful around is how we manage our portfolios, because just today, for example, we are expecting, you know, Biden to come out with a statement on whether the Congress is going to expand the balance sheet even more. So we thought 3 trillion was bad. They might actually come out with 2 trillion today. So you can imagine. So this bubble will continue, and there's a lot of liquidity in financial markets right now, in global financial markets. Just to juxtapose that against what someone like Shiv just mentioned right now. So in Kenya, you had a situation where, you know, there was reduced access to credit for businesses. Now in the US, the same continues. Businesses struggle to get credit, but players on Wall Street continue to get almost as much liquidity as they need from the Federal Reserve at near zero interest rates. And this is expected to continue in 2022 and 2021. Now, this makes it very difficult for asset valuations. Asset valuations become even more difficult to do this year. Just as an example, take a stock like Tesla, for example. Last year, I was just talking on a panel similar to this, and we thought that it was very amazing that Tesla had gone up over 200%, right? And at the time, we felt that, you know what, we might see a recovery or rather some sort of retracement on that stock. This year, as we speak, Tesla is up over 700% and growth year on year. Can you believe that? And it's actually valued more than almost all the major car companies combined. It's such an amazing valuation that, I mean, nobody understands it, not even Elon Musk himself. And that's the effect of what we like to call free money. So we expect that this will continue to make 2021 very interesting, but it's also very exciting, and there's a lot of money to be made in such markets naturally, because then there are a lot of assets that can still be bought. We still continue to think that most commodities will recover, especially if we have more vaccinations being done, and therefore gradual reopening of world economies. So a commodity like oil, for example, we think it might just retest the $50 a barrel level again, if only for the near term. So that's going to be exciting for most traders who are trading such commodities. We believe that most major currencies will gain against the dollar in the medium term. That's a play we continue to hold, and we think it's very useful in case effective markets reverse the moves. Then that can be a good play to have. We still think assets like gold will continue to rise. We saw gold last year print almost $2,000 an ounce, which is something we had been calling for about 2 years since we founded the fund, actually. Then back home, when you look at our currency, of course, again, last year was very exciting for, I don't know that to call it exciting, because obviously if you were buying the dollar against the shilling, that worked for you, but we're an imported economy, and obviously a weaker shilling has made it very difficult for most business people. But then again, we saw the shilling lose over 10% in a year. We've never seen this. I've traded the shilling for a long time. This was quite unprecedented, and goes to show you that, and Kenya is one of the more well-managed, one of the best managed countries in terms of how we manage our currencies. So we expect that this year, a lot of African currencies will continue to be under pressure. Last year alone, we saw the Zambian kwacha lose over 50% in value. And we expect that this kind of pressure on most African currencies will continue. The effects of COVID, even if the vaccines come, there's still an effect in terms of what COVID has taught us about globalization. It's a lot of companies are rethinking their strategies around globalization, and countries in Africa will obviously take a big hit from this paradigm shift, and therefore a lot of African currencies will be under pressure. So that would be something that a lot of investors should be careful about, especially if you're making cross-border investments. So this year, again, we will still be bullish on certain stocks, but our bias now will be less on growth stocks and less tech stocks, and move into more value stocks. So I'd really advise anybody who's looking to buy stocks in major world exchanges now to really try and increase their concentration of value stocks. It's not as exciting, all right? If you buy AT&T, it's nowhere near as exciting as buying Tesla, for example. But I think moving forward, especially if you're an investor in Kenya, because you're investing in these firms in dollars, then you have the added benefit of your dividend yield being augmented by the depreciation of your own local currency, which is a strategy in Mansa X that we use quite a bit to augment our returns. And it's something that we'd also advise investors to look out for in the new year. So I think it's going to be a very interesting year. Biden is now the US president, and we believe that he will most likely, we expect that he might bring in return some of the regulations that Trump had removed. He might return some of the tax cuts that that Trump had implemented, which obviously were one of the reasons why the US stock market went on this bullish run for some time. But we highly doubt that he'll do that immediately. I doubt you'd come into power and immediately start implementing more regulations and scrapping tax cuts immediately. So in fact, we think the reverse is true. He'll probably come in and increase the stimulus amount. For the first time, Democrats were pushing for a higher stimulus amount than the Republicans, and this looks like it's going to pass. And this is actually something that we are all watching right here in the office just today. So I guess 2021 should also just be as exciting as 2020, but I don't think we'll have a year like 2020 again, hopefully, just to echo the words of the other two panelists. Thank you.
I think 2020 was yeah. I think for everybody, we've learned that we actually need better money management skills on our side, on personal notes. Whether it's getting out of debt, whether it's having an emergency fund, whether it's diversifying our investment solutions, and they're there in the market. That's the beauty, yeah. They're there. All those investment solutions are there in the market, and we have the best heads that are there, right, that are there in the market right now with us today. So please keep asking the questions that you have. Already we have a few questions that have come in. Nahashon, before you go away, there is a question from Anjiri. If you could expound on the 5% management fee and also your view on index funds, as well as Bitcoin and future of cryptocurrencies in 2021.
All right, so why does Mansa X charge a 5%? I did not know we were going to discuss this. Okay. All right, why do we charge a 5% management fee? The reason we charge a 5% management fee is because it's a really actively managed fund. So it's a very administratively involving fund to run. Okay, we have a lot of investments that we have to make, not just in the people who trade, but even in the softwares that we use. And then because we are really the first ones doing this sort of thing, setting up and running this vehicle is a lot more expensive, dollar for dollar, compared to a fund manager that's running something that's already been well established in the market. So that's why our management fee tends to seem higher than the other fund managers. And then, sorry, what was the other one?
The future of cryptocurrency in 2021.
All right, so cryptocurrencies. Okay, I'll be honest. We actually do not trade cryptocurrencies in Mansa X. We don't trade Mansa. We don't trade cryptocurrencies because, first of all, we operate in a regulated environment, and the CBK has been very clear that there's some hesitation from the regulator in terms of whether we should trade cryptos or not. So we really like to stay away from them. But what do I think? Again, because of the amount of stimulus in the market right now, because of the amount of liquidity that is flowing right now in global financial markets, to be honest with you, almost any exciting sounding asset class will gain value. All right. We saw Bitcoin gain value from $15,000 a Bitcoin to almost $40,000. All right. You can use all manner of reasons, but of course, the two main reasons are one, of course, the Federal Reserve and some other global central banks are starting to be a bit softer on their stance around Bitcoin. And the second thing, which I think is a major one, you have superstar hedge fund managers, like Guggenheim Capital. You have people like Elon Musk coming out to say, Elon Musk actually came out and said, we're even going to pay our dividends out in Bitcoin. First of all, that is not, that is enough to boost the value of Bitcoin, but the practicability of it is something that can be debated. But because you have such high liquidity in markets right now, a statement like that pushes an asset class like that to crazy levels. I mean, you had hedge fund managers actually coming out with valuation figures. So you have people coming out and saying, we believe that Bitcoin should be trading at $100,000 in 2-3 months. Obviously, that will push the price up. So my opinion, especially if you're running your own individual portfolio, just to be very careful. I believe we will soon see the mother of all busts in all these asset classes. It's going to come. Just be ready for it. So just don't be the one left holding the monkey, as they say.
All right. I think maybe to avoid that, diversify your investment. Don't put all your eggs in one.
Absolutely.
Yes.
Absolutely.
We forgot about the index funds. Index funds?
All right, so index funds. So if you're talking about ETFs, obviously these are very good ways to make money in a bullish market like this, while reducing the amount of money you pay to fund managers like us. All right, and I think obviously when the markets are bullish, it's very easy to make money from them. But in a year where you might need a little bit more active management, because how we earn our keep and the reason we are paid the fund management fees is because we should be able to quickly notice that maybe there might be a turnaround in markets, and therefore get into long and short positions to hedge out your exposure. Okay, so if you're just completely in index funds, that can work for you perfectly in a bull run. And we have been in a bull run for, I think it's the longest bull run we've ever been on, almost more than 12 years. And the Federal Reserve is still pumping money to keep it going. So index funds will continue making money. But I think, again, just like I said about Bitcoin, please remember to diversify. Please remember to prevent, and by diversification, I don't mean you buy the S&P 500, and then you buy Spider Gold, then you buy the DAX, then you buy the FTSE. You still have correlation risk, yeah? So diversification has to be real diversification, and that might be difficult for an individual investor to implement because you might need a lot more capital to implement it properly. So do not buy asset classes that are correlated, because then you're not really diversified. You have one-way risk, and those are things you have to watch out for. But to answer your question, yes, as long as this continues, index funds will continue to make money too.
All right. There's one more for you, Lucy. Can someone lose all their investment in Mansa X?
Yeah, we get that a lot. And we get that a lot because I guess we are the only fund out here that has made it very clear that we don't guarantee returns. But you cannot lose all your money in Mansa X. Why? Because we still use a very conservative trading model. A lot of people tell me, how can you tell me that your model is conservative, yet your returns seem to be way higher than what the other fund managers are giving? It's because of a few reasons. I'll zero in on just about 3 of them. So the first one is we simply just trade a lot more asset classes. It's that simple. We trade a lot more asset classes. So that gives us a lot more available opportunities to make money for you, all right? Then the second reason why we be able to squeeze out a higher return is because we are allowed by the CMA to leverage our portfolio, all right? Now, we don't leverage the entire portfolio. We actually only leverage a fraction of our portfolio, but that is enough to still squeeze out an extra return, even if it's 1 or 2 extra percentage points above other fund managers. And the third thing is that we can trade long or short markets. So if markets are losing value, we can still make money by going short, like we did in April, probably not enough on oil. And also we can make money when markets are going up by going into long trading positions. So all this combined effectively and using a proper portfolio allocation mechanism allows us to squeeze out an extra return for you while still protecting you from downside risks. So, I mean, never say never, of course, but from the way we've designed the fund, it's such that you can never lose all your investor funds.
Okay. All right. I think we'll stop there for now with you. We will go to Shiv at the moment. Shiv, a few questions for your side. You mentioned that real estate firms are making deals based on the price that they normally wouldn't. How can we take advantage of these deals?
Okay.
Then another question is also on the future of real estate, in the real estate industry.
Sorry?
The future of malls.
Malls, okay.
In the real estate industry, yes.
I think the first one is thanks, Rose, for the 2 questions. The first one is on real estate pricing. How does someone take advantage of it? I think it's obviously approaching a developer whose real estate product that you like. I mean, if you're looking for apartments, if you're looking for villas, if you're looking for a master plan community, if you're looking for holiday homes, this is a good time to approach a real estate developer. So how do you take advantage of it is to begin that conversation. If you see real estate developments that you like, if you see something good that's coming up, it's a nice time to actually approach a developer, ask for an extended payment plan, ask for a deal. Will it last forever? No, but over the next couple of months, obviously, as people try to manage their cash flows, they will be willing to do deals. Obviously, there is time value of money. Money today is more valuable than money in the future. So a lot of people will be willing to listen to that. And that's really what you can do. There are places where you obviously won't get deals, but that shows you the resilience of a couple of markets. I'll give you an example of our development at Green Park. we did have to extend our payment plans, offer clients deals. But given that we offer sort of master plan communities where people have their own space, they're not in an apartment block, they have their own gardens, they can work from home peacefully, they've got convenience within the estate. It's 500 homes on 160 acres. So over there, you're actually seeing a lot more demand than you actually saw before, because people are keen to actually live where there's more open space, where they can work from home, where they can work out, in peace. So you have to really pick your spots when you're looking for deals as well. What's the future of malls? My personal view is that retail is just going to recover as quickly as people can get vaccinated. Does it mean that people will stop going to a mall? No. I went down to the Yaya Center and Sarit Center the other day, and both of them are doing phenomenally well. They're almost 98-99% let out in terms of for both those malls, in terms of where they are. Their performance is phenomenal. People are just putting on a mask and carrying on with their lives. So, retail in the right location and the right type of offering with the right retail mix continues to deliver value. And Sarit Center and Yaya Center are two good examples of that.
All right, and there's one more. Why would you say, or when is a good time to buy or sell for an investor in the real estate space?
Look, it really depends on an investor and where you got in. A good time to buy is obviously if you're looking for a trusted off-plan partner, someone who will deliver the project to you within the timelines that they've agreed. Obviously, no one can promise real estate's difficult once you get onto the ground. But a good time to buy would be to come into the market a bit earlier than someone else. When you also view infrastructure, where are roads going? Where is railways going? Where are industries moving to? It's a good time to start thinking about, okay, you know what, actually, it could be something interesting to buy there, because the roads have to be leading to something. And they might not lead to it today, but they will lead to something 10 years from now. So it's follow the infrastructure, look at where industry is going, look at where railways are going, look at where roads are going. Those are always good indicators of where real estate will appreciate. When is a good time to sell? It's difficult to tell people not to be greedy, because they always think that they can make a lot more money than they actually can. But when your market starts to get saturated, when you've not seen an increase in your rental prices for 1 or 2 years, when you've not seen any capital appreciation on your valuation in 1 to 2 years, before you start getting into what is known as prime residential declines, then you should start to look to sell. That's more relevant in a lot of developed markets, the US, UK, Europe, where markets do reach saturation level. It is the case in a certain number of subsectors within the Kenyan economy, but by and large, when you look at an economy that's growing, you see satellite towns, you see urbanization, prices generally tend to increase, even if they do at just GDP level during a normal economy. So yeah, it's almost, when can I make more money in another asset class? If I'm only making 6 to 7% in my real estate, but I can make 9% in fixed income and carry much less risk, it's a good time to sell. But if I can make 12, 13% in my real estate versus 8, 9% in fixed income, then it's a good time to keep it on a risk-adjusted basis. So it's also looking at your individual portfolio and asking yourself, how much return am I making today vis-a-vis other asset classes? And I like to compare fixed income, because real estate is really capital appreciation and rental income. And that's exactly what a bond is. It's capital appreciation and your fixed income, or your coupons that you get paid. So it's really just to compare the two and see, how do I perform on an asset class by asset class basis.
Okay, all right. I hope you've been answered. There is a question from Kendago. I think this is for you, Shiv. How is the Kenyan market embracing digital technologies to make investment operations easily accessible, trustworthy, and safe? I don't know. Might be for you. I think it's on the private equity side.
I think it's more a Caleb question, but I'm
Yeah.
happy to take it. Look, from No, actually, I think it's a Caleb question.
I think so too.
All right, let me jump in on that one. We're embracing digital technologies through a number of ways. You know, right now you can go online to your Google Play Store or your Apple Store and get download an app by your fund manager, or you can easily buy or sell securities directly from your app, or also invest directly from your app. There's also a number of I would say direct investments that you can do directly from your phone using M-Pesa. You can invest directly into a number of collective investment scheme unit trust products directly from your phone. So you just pay that transaction cost. And also there's a product that's coming up where you can just invest directly from your phone without incurring that M-Pesa transaction cost. So basically, we're trying to reach more consumers or customers through embracing these alternative, we're calling them alternative distribution channels. You have your apps on your phone. You have your online. You can also access your investments online. You can get into a portal online and manage your investments also from an online portal. Those are the things that we're looking at in terms of digitization.
And Rose, if I can also step in from a real estate perspective,
Yes, please.
you know, ordinarily you would have once seen, you know, buyers drive in towards sites or fly in to view international properties. But I think as a response, real estate developers and investors have embraced digitization. You know, they've promoted virtual viewings, virtual tours, which successfully enabled us to, you know, maintain and spark buyer motivation. More than anything. And the pandemic has really highlighted the amount of space there is for digital and technological innovation within real estate as well.
Okay. Caleb, there is a long question for you, very long one. But here, I'm requesting Caleb to expound more on the assumption he made that most things are going back to norm, that make the investment outlooks look more promising in 2021. I stand to be corrected, but in my view, increased transactional costs and taxes, as well as limited credit facilities, might make it hard to realize this, like the microeconomic fundamental in Kenya do not support your argument.
Okay. But what I meant by going back to the norm is, you see, during the pandemic, there were a lot of, I'll say, initiatives that were brought out to help ease the consumers and the general public through the pandemic. You know, the waiving of fees on your transaction costs, the mass restructuring of loans by the banks, the relief on your personal income tax that was given by the KRA. And now reversing back to the norm is basically these, I'll say, stopgap measures are being taken back. So we're now going back to paying higher taxes, we're going back to paying transaction costs, and we're going back to banks are not restructuring loans as at the rate or at the pace that they were doing in 2020. And this is mainly because we're seeing the macroeconomic environment. Basically, when I say things are going back to normal, you see the schools have reopened. We're finding new ways of doing things. I'll say people are back to work, you know, just sanitizing, keeping your masks on and the like. And we expect economic growth to pick up this year, the business environment to remain high, expansionary this year, to be that will be now supportive to businesses, and this will spur economic growth and activity. So basically, the macroeconomic outlook this year does look better than last year. You know, the private sector credit growth is still rising. It's around 8% or so, and this is because banks are still giving out facilities. Yes, there have been a lot of restructuring that happened last year. But a lot of bank executives are saying that their clients and customers are getting better at repayment, and this is a direct result from these businesses being more afloat. Basically, the business has become more stable. Customers are paying them. There's more orders. There's a lot of orders by customers in the businesses, and they're paying them. So I'll say, going back to normal, we're looking at a better macroeconomic environment as compared to the pandemic.
I think you will take this, and it's addressed to Nahashan, but you will both share your views. What's your take on the banking stocks after most of them have held back from paying out dividends?
Sure. We're actually going to look at sort of a dividend draw. I think it was highlighted sometime today. Basically, owing to the capital buffers the central bank is requiring a lot of banks to maintain, especially because of the high levels of non-performing loans that was experienced last year. So the central bank is almost mandating banks to hold more capital, have a larger capital buffer. So this will result in a lot of dividends not being paid by your major banks, your KCBs, your equities. Equity even didn't pay a dividend last year. So we're looking at a slight decline, or not a decline in dividends for 2020. Obviously, because of we also had a decline in earnings. A lot of banks have issued profit warnings, so they expect their profits to be less than 25% of what they had in 2019, and then it becomes a bit more difficult to pay out the same level of dividends given a decline in earnings and the business is not growing. So the prudent measure is for banks to keep the capital buffers. There's a lot of provisioning that will also happen this year because of the non-performing loans, and that will result in dividends either being non-existent or being generally much smaller than what was in 2019.
Okay, all right. Nahashan, your take? You're muted.
Oh, sorry. Well, I totally agree with Caleb, obviously. I mean, banks at this time more than any other need to really protect their capital, and in fact, they need to boost it. It's a very precarious time for Kenyan banks because on one hand, you have Kenyans struggling to make their businesses work, and then you have a government that's probably not spending as much locally as they should. In fact, they're borrowing. So those two circumstances work against you, and they can really erode your capital very quickly if you're not careful. So obviously, one of the ways to boost your capital right now is to protect your cash flow out by not paying dividends. That seems like a no-brainer for sure.
Okay, I think I've used the biggest phrase for 2020 on you. You're muted. You're on mute. But yes. There's also a question, I think it's to Caleb. It was the first question that was actually asked by Whitney, who's a 22-year-old. Is there a youth-friendly investment product in place for the youth who want to invest?
Oh, okay. There are a number of investment products for youth. It doesn't really have age limits. Though I'll say she is a bit younger. I would say maybe possibly starting out their career. It's also a bit easier for them to take on more risk. So you can look at going into any alternative assets, going into equity funds, because you have a longer term horizon at your disposal, because you're just coming into your working life. So you have many working years ahead of you. So you have the opportunity to withstand the gyrations, the ups and downs in various markets of a longer period, a longer term horizon. Also, if you're more risk averse, there are a number of options that you can look at. You can look at the money market funds, fixed income funds that give you a given stated return, though it's a bit also a bit lower in the long term, vis-a-vis, let's say, investing in one of these asset classes that has a longer term horizon, a bit more risk, but a bit more return. So you can look at any collective investment scheme. You can also look at alternative assets. We have products that are there. We have real estate. We have other funds that invest in alternative assets. We have investing directly in, we can say something like commodities or rare artifacts. There are a lot of investment opportunities for you, especially at that age, because you have your entire working life, I would say, in front of you.
Yes. All right. I don't know whether there are any more questions. Please keep them coming. However, we are almost coming to the end of the session. I would request Shiv at the moment to just give us a brief outro as we go out. You tell still on the aspect of what we are expecting in 2021 when it comes to real estate and private equity. How aggressively should we invest there?
Rose, it's thanks. So obviously it's shaping up to be after a couple of years of difficult period for the real estate sector. I think it's shaping up to be a better year. I would say there's sort of a couple of trends which we need to look out for. The first is obviously Kenya's position as a business hub. It's going to obviously foster a lot of resilience in the market for alternative assets. If global investors, local investors are looking for long-term exposure and are willing to wade through the ups and downs, it obviously offers the best sort of risk-adjusted return. Also in terms of we don't have a huge single dependence on a particular sector in terms of our GDP. So Kenya's position as a regional hub is going to help. Government intervention is starting to aid market recovery. I saw in the Business Daily today that the entire Eastlands is going to be done through public-private partnerships for a number of affordable housing developments. So we're going to start to see a lot of that come into the market. But on the flip side, public-private partnerships don't always work because government's expectation of a return on capital versus a private investors are very, very different. And also matching durations. Government can stay in there 10, 12 years, private investors can't. But definitely something to look out for. But government has started to aid the economy. And at the same time, they are starting to spur affordable housing developments. Third is, mortgages. It's going to be difficult this year. As Caleb and Najan very, very rightly talked about, banks, if you look at their levels of provisioning, will go up. If you look at non-performing loans, will go up. If you look at industry credit exposure, a lot of that is generally in the alternative investment sector. So it's going to be difficult towards getting a mortgage. Also because people have been out of jobs, people have been made redundant, and businesses have suffered. But so mortgage rates might be, you'll probably get a cheaper mortgage because you can also negotiate if you've got good credit, but it's going to be more difficult to get one. I think homes with like master planned estates, holiday homes, people's second homes where they can actually get a refuge away from the hustle and bustle of city life will start to ease up. The one thing that obviously concerns us is the political environment. Will it hold up? We're seeing a lot of noise with regards to BBI that coming up towards elections, referendum. Those things are never good for an investor taking a very long-term view. We almost need 10 years of uninterrupted growth, but unfortunately in Kenya we don't have that. Every sort of 2 to 3 years where we're stopping and starting and stopping and starting. So it's not going to be obviously that's not the best signal, but we'll wait through it as long as credit continues, demand picks up, and it has started picking up. I mean, for us, the start of the year has been it's been better than we had anticipated. So we hope that trend sort of continues and investor confidence continues.
Okay. I think you've actually answered a question that has just come in for you. Your general outlook on the construction industry as a whole. I don't know whether there's anything you've left out.
I mean, generally, just from the construction perspective as well, we're going to see an increase in the amount of approvals this year, obviously compared to last year, especially for building approvals, building permits. So that will mean it's better. cement and steel prices have remained largely flat throughout the whole of last year. So that's been good for construction to be able to plan as well. And you know, a lot of contractors who were previously out of work are now looking to come back in and be more competitive in terms of their pricing. So that helps the market as well.
All right. I think we go to Nahashon. Just don't leave yet, Shiv. But we go to Nahashon. Whitney had spoken to customer care at SIB, and they were telling her that the youth-friendly investment product was to launch this year. Is it still on?
Yes, absolutely. So we are launching a product very soon, and that's going to be more accessible to everybody. So right now, as you probably know, the minimum investment for Mansa X is 250,000 shillings. And whereas, yes, we've had a lot of success with this product, there's still a lot of Kenyans we feel are missing out on exposure to the kind of investments that we do. But the only reason why we had hesitated at the beginning to start with that, because it will require better distribution channels to be able to successfully deploy. So now we are at the tail end of creating mobile-based solutions in terms of how we are going to market a particular product that will soon be launched in the market. So it's not just for the youth, it's for anybody who is aspiring to have a better diversified portfolio, but might not meet that criteria of 250,000 shillings. To answer your question, within the first quarter of this year, we'll bring out something very exciting to the market.
All right. And also, if you don't mind just giving us, there was a question the earlier question that we asked about bank stocks.
Yes.
The local bank stocks. The clarification in the question is, what is the outlook on trading?
On trading local bank stocks, I feel that's a Caleb question.
Yeah, I think so too.
That's a Caleb question. Yeah. Let me pass on that to Caleb.
Yeah.
Okay, so on trading banking stocks, we saw last year banking stocks really suffered the brunt of the declines in the NSE. I would say like equity and KCB were down almost 30%. And this year, we do expect, as investors try to start to price in expectations for earnings growth. Remember, last year we had a lot of banks that were issuing profit warnings. So basically, the profit, the earnings were down more than 25%. But this year, given the recovery that we expect to happen, once investors start pricing in the earnings growth in these stocks, we'll find that a lot of the counters are undervalued. So there's a potential to increase. There's a potential for them to rally. Though there's also the hindrance of dividends, as we talked a bit earlier, that there's going to be a dividend drought. So we expect that there might be a case of two halves in 2021. One, possibly the first half, where stocks don't do as well, and then as earnings growth picks up later in the year, then we can see a rally in these counters.
Right. Okay. We are almost at the very tail end of the session. Caleb, I would ask you to just do your maybe just a final outlook, and then we go to Nahashon, and then I don't think there are any more questions, but if there are any more questions, we can shoot them and we shall forward them to the panelists, and then we can answer them on email.
Sure. Okay, so as we talked about the outlook, we do expect a better macroeconomic environment this year, and this should be supportive for stocks in general. But we have an issue on the trading valuation. When you look at the historical average, the historical average price to earnings for the markets around 12.9 times, 12.8 times, and we're currently around 11.5. So there's still a discount when you come in to buy the markets based on earnings. However, the discount is not that. I'll say the discount is not that attractive, because it's around 10 to 12%. However, as earnings picks up this year, as is the expectation, then the price to earnings ratio should also come down, and this should provide a a better discount towards historical averages, assuming that the markets tend to revert back to historical averages. So equities will still remain positive. We expect a better performance this year than last year. Last year, the market was down close to 9%, and this was mainly just because Safaricom rallied. If Safaricom had not rallied, and given that it's more than 50% of the market, then the market will have been down around 20%. So we do expect a broader-based selection of counters this year to do better than last year. Price recovery and discovery in a number of them, as investors, as we said, start pricing earnings expectations for this year being higher than last year, and possibly also being higher than expectation. So we do expect a positive outlook on equities. When it comes to fixed income, the government is still has a high appetite for debt. Even if you look at the bond that just closed, the 2-year was greatly oversubscribed, and the CBK ended up taking almost all the bids that were floated. This is because the government is actually looking for funds, and there's also a lot of maturities coming in this year, especially from treasury bills. And this should also put some pressure on interest rates. So we expect a bit of a slight uptick in interest rates this year. So we expect interest rates also to rise. When you look at another flip side, government borrowing, KRA revenue collection, we still expect that to be a bit subdued, though there are some measures being implemented by the KRA in trying to unnab some taxes, and we expect that to have a slight uptick, because the main source of revenue funds from the government again is private sector businesses, and this has taken a hit last year. So we don't expect a lot of tax from companies because profits have come lower. So even the tax will come lower as well. So apart from that, monetary policy, we expect that to remain a bit remain accommodative this year, the same as last year. Given the pandemic, as we come to the tail end, basically we're looking at if there's going to be vaccination coming in early into the country. If you get something this quarter, then things can go back to how they were pre-COVID much earlier this year, and this will still spur the economic growth further than the expected expectation of around 6% growth. So we have a positive outlook on equities, and fixed income. We're looking at a bit higher yields this year, as following as we get back to normal levels and the vaccination comes in.
Yeah. All right, perfect. I think we have this will be our year for sure. Yes.
Yeah, we're looking at that.
We can say that.
Yeah.
Yeah. Nahashan, any final?
I really wish I had the optimism of Rose. Well, obviously, yeah, we are really hoping for a good year from the perspective of with the vaccines being rolled out successfully. We expect that the world should start going back to normal. Travel might be renewed, and this obviously should improve the fortunes of most companies that are listed, and then many other asset classes that took a hit in 2020. We're also looking forward to the proper conclusion of the Brexit deal. That's something everybody is looking at, and there are all indications that this might actually be concluded properly this year, and that will have a big impact, especially on the valuations of, for example, the sterling against the dollar. And we also now excited that we have a new president in the US. It's been an interesting period for us, especially last year. We don't even need to go into the details, but let's see how Biden will play out in terms of whether we'll go back into more regulations, especially around the oil industry and Wall Street, as well as how he treats the tax cuts that were implemented by his predecessor. So those are the things we'll be looking at. Those are the three main events that I think will move markets in the first quarter of this year. But I think an overriding theme, no matter what happens, is that we might continue to see a weaker dollar. And we at Mansa X continue to be dollar bearish against most major world currencies. We still think that there might be a bit of recovery in oil prices, and we still think that the shiny metal, gold, will continue being shiny this year. So we'll continue advocating for investments in gold as well. And again, as mentioned earlier, we really want to emphasize the need for diversification. A lot of people ask me every time, what return does Mansa X give? Can you give me a higher return? But I keep telling people that there's a lot more than just return. When you're investing in a fund, it's also very important to look at certain things like, do you get consistent cash flows from that fund? And how liquid is that fund? That's very important. So at Mansa X, we've obviously had a good run. Everybody's talking about it, but it's also very important to note that at Mansa X, we actually mostly look at ensuring that our fund remains liquid and at the same time protecting downside risks. That remains very important to us. And we expect that 2021, therefore, should be an exciting year.
You see, you have the optimism as well.
Yeah, you've infected me.
Yes. Shiv, any final words?
Yeah, I think everyone's just looking for some optimism as well. But no, I think everyone's just got to put their head down and work towards making this this a better year. You know, we've just got to understand that this is sort of a new normal. So, you know, put on your mask, make sure you keep safe, and Rose, thanks for organizing this. I think I've learned a lot today as well from the panelists, from the questions that were asked as well. So yeah, let's make this regular. Yeah.
Oh, perfect. It's good to hear that. Yeah, when we call on you again, you shall come. On our side, yes, we are doing free webinars throughout the year. So, and we did through the COVID period, we saw an increased number of people wanting to know about investments. Yeah, and so keep checking on us as Vasili Africa as well. We shall be having different people coming in to talk about the investment solutions that are there in the market and how we can make money. I think this is the year we should actually take our money make very deliberate and intentional decisions about our investment lives. Yeah. So for now, I would say thank you so much for joining us. There were a total of about 95 people altogether. We have a database of about 200 people, more than 200 people actually signed in, some last minute. So we shall be sending the recorded version of this to your emails. As well, it was airing on Facebook. So yes, it was, yeah, I think it was an exciting first webinar of the year. And thank you very much for joining us. If you want to know more about the investment solutions that are there in the market, that have been talked about, please reach out to us. We shall hook you up with a fund manager, and yeah, you can start your investment journey. Whitney, we are looking at you. Asanteni sana for joining us. God bless you all. Have a lovely, lovely evening.
Thank you very much.
Thank you, Rose.
Thank you.